Yes, today we are going to see and understand the meaning of what we call the supply and the demand area zones in a financial market. As the word pronounces, supply and demand. We all know that in commerce, that when the demand for a particular commodity increases, automatically its prices have to go high. I repeat, when the demand for a particular commodity in commerce increases, when the demand increases, the prices for such a particular commodity have to go high. And it is a vice versa. When the supply for a particular commodity increases, when the supply increases, automatically the prices have to go down or lower. And when the supply decreases, the prices automatically have to go higher. So it is just a simple knowledge. When the demand for a particular commodity increases, the price also have to increase in case the demand increases. And when the demand for a particular commodity decreases, when the demand for a particular commodity decreases, of course its prices also have to go down. So it is the same case with the supply, whereby if the supply for a particular commodity in the market increases, the prices lowers or go down. And when the supply decreases, automatically the prices have to grow or come higher. So here we have the supply area and the demand zones in a forex market. Of course, the supply area or zone is created by the sellers. Of course, the supply area or the supply zone, it is at a certain level whereby the sellers are starting to sell or selling at a particular commodity, and at that point the buyers who are trying to buy cannot buy the market at the price that is beyond the price at which the sellers are selling the market. And the same case applies to what we call the demand zone. In the demand zone, here the sellers cannot sell the market at the price that is higher than what the buyers are buying the market. So the price is being rejected. So for that case, here we are seeing a supply zone because we are seeing that the market was trending up, meaning that it was the buyers in control of the market. But at a certain level, the prices at which the buyers are buying the market cannot go past the price at which the sellers are selling the market. Automatically the market has to reverse. So we term that as a supply area or zone in case the buying prices are being rejected by the selling price. So here we are seeing our red horizontal line that we are observing. So we call this a demand area. So as we are seeing, the market was trending upwards, meaning that it was the sellers in control of the market. But at a certain level, sellers couldn't sell the market past the price at which the buyers are buying the market. Therefore, the market had to reverse. So that's a simple technique between all the physiology behind the supply and the demand zone. So now we are going to see how we can trade the engulfing bar candlestick formation within the supply and the demand areas or zones. Supply and the demand areas are more powerful than the support and the resistance levels, and it is the place where banks and institutions are involved in the market, either by buying or selling the market. And if you can identify these turning points, you can make a difference in your trading account. To trade the engulfing bar candlestick pattern formation successfully with the demand and the supply areas or zones, you have to be able to identify the quality, supply, and the demand levels on the chart, especially if you are using your trading view. So you have to be able to identify the quality supply and the demand levels or areas on your chart. According to my experience, we have three factors that define quality, supply, and demand area zones, and it is these factors that we can base on to identify or say that this is a demand area or this is a supply zone or area. The first factor is what we call the strength of the move. Here you have to pay more attention on the way the prices leaves the zone. If the market prices leave the areas quickly, this is an indication that banks and institutions are there, and therefore we are experiencing a supply zone at that point. So the second factor that we can base on is what we call the good profit zone. Here you have to make sure that the level provides a good risk reward ratio. Yes, the third factor that we can base on to say that this is a demand or this is a supply zone is the bigger time frames. So we are saying that the daily and the 4-hour supply and the demand area zones are the most powerful zones in the market, and the illustration below is going to show us how a quality supply area looks like, and you are going to see that the move was very strong, and this indicates that the banks and the institutions were there in the market struggling. Therefore, the formation of an engulfing bar candlestick was a clear signal that the buyers are still willing to sell the market from the same price level. Therefore, this is the illustration. So we are seeing our supply area. So the formation of an engulfing bar at that level, meaning was a clear indication that the banks and institutions were still there to sell the market, and at that point the candlestick that is being formed, it is what we call a bearish engulfing bar candlestick. Therefore, its formation indicates a sell signal. That's why we are seeing our market trending downwards, and at that point the buyers cannot sell past the price at which these banks and institutions are willing to sell. So the buying price has to be rejected, and then it is the sellers to take control of the market. And it is the reason why we are seeing our market trending downwards. And therefore, this is another example that we can base on. The first one was an uptrend market, and this is a downtrend market. Therefore, we are seeing a stronger move whereby the banks or institutions are involved in the market. It may be news from the banks or from certain financial institutions that can cause these stronger moves. So we are having our supply area whereby the buying prices are being rejected, or the buyers cannot buy the market at the price higher than what the sellers are willing to sell the market. So we are having our supply area or zone. You can observe it very clearly, and the formation of an amplifying bar candlestick pattern in the supply area was a clear indication of a market reversal downwards, because it is a bearish one, and at that point it indicates a sell signal. And it is the reason why we are seeing our market continuing in a down trend. Yes, and I think that is not complicated to identify these zones, because they are characterized by strong moves, and the secret behind the supply and the demand areas is that big players, I mean the buyers, it may be the buyers or the sellers, put their pending orders there when the market approaches these zones. I mean the supply and the demand zone, the supply and the demand zones. And here we can see a crazy move from these levels. Of course, when you try to observe from the illustration, it is not complicated, because it is characterized by a stronger move, and the secret behind these levels is that big players put their pending orders there when the prices approach these levels, and we are seeing a crazy move either in a downtrend or in an uptrend. And if you try to combine trading the supply and the demanding zone areas with the engulfing price action signal or strategy, this is going to help you increase your chance of making profits as a professional trader. Yes, we are going to end here for today, and in the next video we are going to be looking at what we call money management, and yes, money management, and how we can take risks, especially when trading the engulfing back candlestick strategy, how we can manage our trading account. So the next video is all about money management in combination with the engulfing back candlestick formation. I just want to thank you for watching. You can have a good day. Yes, may God bless you.